We're in Denver, Colorado at EnerCom's 18th Annual Oil and Gas Conference. I'd like to welcome Neal Dingmann, Managing Director at SunTrust. Hey, Neal.
Good to see you.
Now, what are you seeing that's different at this year's conference? One, on the financial side, and two, on the operations side?
That's good questions. I mean, definitely this year what I've noticed is more on the finance side. A lot of concern over the balance sheet. People don't want too much debt, don't want too much leverage, so that's not just the debt, but even including preferred. And what's very noticeable is just the interest in those companies that are over-levered. There's just not the interest here that I've seen other years, so it's pretty obvious right now to me that to be a successful E&P company, you can have some debt, but you really have to watch that optimal level. So I think that's number one. And then operation, I think right now what's going on is people are looking for some of these hot plays on what's going out there right now. And certainly, I mean, too, that one got a little traction last year and getting much more this year, and that being the Utica. So right now, a lot of guys have been talking to me about the Utica. A company like PDC Energy was here and getting just a lot of exposure about this company. Just the upside to me is tremendous. There's a lot of areas in Ohio that you can see them expand, so it seems that a lot of these clients are looking for new plays like that. The other one to me that was probably very interesting one is called the Tuscaloosa Marine Shale, a company called Goodrich Petroleum. It's been here now a number of years. I mean, it feels like for the last 18 years they've been here. But this year in particular, I noticed yesterday their stock was up over 10%. Just the interest this year I've noticed over a play like this has just really been more than I've seen the last 2, 3, 4, 5 years at this conference. So what's pretty evident is people aren't dismissing the older plays, but they're certainly looking for new plays. And judging by what the stock price of both PDC and Goodrich has done, it's pretty evident that they're sort of putting their money where their mouth is also.
Neal, what about some of the existing plays like the Eagle Ford?
It's interesting. With the existing, there's still a lot of attention here. And, again, a lot of the clients, there's been some standing room only crowds, EOG, a lot of the companies that have been there now for a long time. Then you've got companies like Sanchez Oil and Gas that was here. And, what's interesting about both is that it's kind of a mixed blessing, and on one side it's positive for the E&Ps, and that is that we're noticing that these plays, or the E&Ps like Sanchez or an EOG, they're able to ramp up in these plays now that have been around for a year or two, and they're doing that not necessarily by throwing a bunch of rigs at it. They're not having to go from 1 to 3 rigs to ramp, but by having more intensity, by maybe having longer laterals, by having higher pressure, more frac stages. They're seeing that each of these wells have better results. So for them, that means higher, obviously, production, higher cash flow. But unfortunately, some of the oil services that were here, they're not seeing the need for more rigs, more workover rigs, more frac trucks, etc. So it's kind of, a mixed blessing. The positive side is, obviously, for the E&Ps, and the ones that seem to be suffering for that seem to be some of the oil field services right now.
What about gas prices? Where do you see gas prices going?
Right, it's an interesting question, and there's been a lot of speculation, I think, what's going on. But again, to me, it comes to simple economics, just supply and demand, and I don't see the demand necessarily changing to a large degree over the next year or two. It probably is going to be when you have more LNG exports, which is about somewhere between 3 to 5 years away. So on the demand side, I don't see that change in the next 1 to 3 years. So it's really the supply side that's going to drive it. And I guess my fear is, and why I've probably been more cautious than most analysts, is that you just come to a conference like this and you listen to Range Resources or EQT, who both of these companies I consider kind of the king of the Marcellus, both have had just a tremendous track record, and it's almost a victim of their own success as they continue to produce more. Both are still getting obviously very good sales and revenue from that. But again, what I think we're going to continue to see is they continue to ramp more and more. It could put a little pressure on prices. But so I guess how I look at it right now, we've been range bound. We're kind of around 340, 350. But because of all the supply that I see still coming in the next at least 1 to 3 years before the LNG demand comes on, I see it kind of sitting pretty flat at best, unfortunately. So I'm probably a bit more bullish than I am. I'm a bit more bullish on the oil and NGL side than I am on dry gas right now.
Neal, some good information as always.
Thank you. Nice to do it. Thank you.
Thank you for being here. I'm Quinn Nguyen for oilandgas360.com.